This is the Building Wealth Podcast with your host, Stephen P. Sitkowski.
Welcome, everybody. Stephen Sitkowski here. This is my Building Wealth podcast. Delighted to have you. So I have a particular topic that I'll be covering at the end today that one of our viewers had requested. So I'll give you an email. And if you've got a topic, you've got a question, you want to run it by me, feel free. I want this to be all about you, your interests, and bottom line is, how can I help? So today's topic, somebody asked me, do you have any tools that you can recommend for doing fundamental analysis on a company? I do, and it's free, and I'll share it with you. How's that? So we will get there. So it is the 24th of August as we start to wind down the summer season. I love the summer, but I can't wait to start skiing again. So there's my email address. I realize some of you are on audio only mode. So if you can't see it, it is stevesitkowski@gmail.com. So a little bit of my background, I've been working with people and their money now for 45 years. That's a long time, isn't it? I like to think I've picked up a thing or two along the way. I have trained somewhere between 1.5 million and 2 million people. I've sort of stopped counting. That's an approximation. I've had classes as small as 10 and as big as 9,000. That was a trip. That was in Chicago. I'm standing on the same piece of real estate where Michael Jordan had played basketball in this wonderful arena. But I love to teach. It's kind of what I do. Some say I preach. That's okay too. So, as a reminder, everything that we do here is for educational purposes only. It is not intended as investment advice. So, even though I may talk about certain stocks or feel like, a particular stock has good value at its current pricing, I'm not telling you to run out and buy it. I don't know enough about you to make that kind of a recommendation. So, I'm just sharing my own thoughts and strategies that I'm using and things that I'm looking at. What's moving the markets? So the Treasury, not my, I've got to change that or it'll drive me nuts. Um, let's try this a little different way. There we go. The Treasury may use the General Accounting Fund for purchasing debt. So the big push right now seems to be from the White House trying to get interest rates under control. Now, the easiest way to do that would be to end the war in Iran. Oil prices would come down, interest rates would come down. So, I mean, like everybody else, I'd be happy to see lower interest rates. Not for me personally, because I earn interest, I don't pay interest. But I know there's a lot of people out there strapped with debt. So if you're one of them, I feel for you. I've been there. I know what that feels like. But I am a little concerned when the government tries to manipulate anything, stock market, the bond market, in this case, the bond market. So I would say stop screwing around with manipulating the bond market and go work an acceptable deal with Iran that we can live with and they can live with. Get the Strait of Hormuz opened, get oil prices down, and interest rates will come down all by themselves, the way they should. Market conditions. The SOXX, so these are chip manufacturers, off 3% open the session today. And primarily, this is the reason why you see the market lower. Now, it'll depend on when you watch this. I'm recording it on Monday, the 24th. So today, the NASDAQ is down about 0.6%. And a lot of the high flyers are down, including Nvidia, which is down for the seventh straight day. I own Nvidia. Am I really worried about this? I am not. Stocks go up, stocks go down. All I care about is that we get higher highs. And I'm going to bet on Nvidia to the end. I don't think there's a better place to be if you're looking for exposure to AI. All roads lead through Nvidia. So the 10-year slightly lower at 4.696. It had gotten above 4.7%. And, this is a byproduct of this bond buying that's going on. And it's fine. I mean, a lower 10-year means lower mortgages, means more people can afford housing. I was talking to a buddy of mine who lives in Central Florida, and he said their housing market, and of course it's regional, but it has dried up. 2, 3 years ago, multiple offers on everything that went on the market. Now, having a hard time finding people who can qualify for the mortgages. Prices have gone up and interest rates have gone up. And I think in many ways, the dream of home ownership is starting to evaporate. Unfortunately, there's a lot of people who believe I'm never going to be able to afford to own a home. How sad. I think I owned my first house, I don't know, 23, somewhere around there. It was a big deal to me. Well, prices are down, no thanks to what's going on with Iran. But we were at 87. We're still at, hell, 85. Still way too high. Still going to cost you $100 to fill your gas tank. That's no fun for anybody. So that's kind of where we are and what's moving the markets. Last week's market breadth, those of you that follow me, there's two things I'm interested in, advancers versus decliners, and stocks hitting 52-week highs versus 52-week lows. And we call this market breadth. So on the New York Stock Exchange, we had 1,079 stocks that were higher on the week, 1,763 that were lower. That's kind of ugly. New highs, 202, new lows, 259. All of that is relatively bearish. Not that we're in a bearish market, but it was definitely a bearish week. On the NASDAQ, 2,154 stocks higher, 3,074 lower. Now, the new highs still trump the new lows, 473 to 446. A little encouraging. Of course, after today, if they had to redo that, it might be the reverse. But that's where we were on the week. So down a week, but not awful, right? We're not pressing the panic button yet. Last week's heat map. So kind of what I look at is, first of all, red versus green. Clearly, red dominated. Those are stocks that are lower, green are stocks that are higher. Then I go looking for pockets, and technology certainly was off last week. Intel down 12%, Seagate Technology down 12%, Western Digital, which has been doing really well, down almost 10%. So you see a lot of relatively big losers. Walmart, which reported and missed on their earnings, and their guidance wasn't great. They said the consumer is softening. Well, my assumption is And I don't want to stereotype, but I think you can logically conclude that the person that is struggling to fill their gas tank is the person that's shopping at Walmart. So they've got fewer dollars to spend. It makes sense. Energy is up. Yeah, energy loves crisis in the Middle East. Healthcare was up on the week and pretty significant. There was an announcement that Moderna has developed a vaccine. They're in partnership with Merck on it. Um, and it's supposed to be for skin cancer. So Moderna stock was up 140%. Merck, a much larger enterprise, was up 12%. So kind of an ugly looking heat map, to be very candid with you. ETFs, those are exchange traded funds, saw a minor pullback in terms of capital inflow. It had been rocking um, between December and July. And now in the last 3 weeks, we have seen 6.3 billion of outflows. That means people selling their ETFs and not reinvesting in another one. What does that tell you? People getting a little nervous. It's been a fantastic earnings season. So this is what builds my confidence in the market moving forward in spite of oil prices and interest rates. 87% of the S&P beat their earnings estimate. So 358 beat, only 39 misses. And then on the revenue side, 336 beat, 106 misses. So it's been a fantastic earnings season. And earnings momentum is the highest we have seen since 2011. So we're just watching earnings grow, grow, grow. Pretty fantastic. That's what's carrying the day. PMI, this is Purchasing Managers Index. So basically, they're talking to the people who are making decisions at the corporate level relative to what they do or don't need. And it's very strong. I mean, if you look over on the far right hand, look at how it's bounced and moving higher. So most everything connected with small business has been positive. Small business optimism is up, profitability is up. The Russell 2000, which deals with small cap stocks, um, has outperformed the general market on the year. And again, this is something that gives me confidence because what is the real driver of the market? Small business, right? Their hiring is forecasted to go up for the next 12 months. Here's something that's a little disconcerting. Debt is on the rise, mostly at the government level, not as much um, and the corporate level. I mean, look at that spike, right? So, it used to be that government debt was under our GDP number. Not anymore. Now we're sitting at about 120% of our GDP. So at some point, does that bubble pop? I don't know. It's not great. I don't like where we are, but um, as of right now, we've got, as a country, the income to service that. So we being the United States, market sentiment has been overall bearish. Now, this is a survey done of independent investors. And traditionally, when asked, what do you think the market's going to do for the next 6 months? 37.5% will say higher, 31% lower. Well, as of the 19th, so that was last week, 35.5% said higher, which was a small improvement over the previous week. 39.9% said lower. So more betting that the market goes down than goes up. And the bearishness actually increased 2 percentage points from the 12th to the 19th. People are getting a little nervous. I don't blame them. I also think people are getting a little fatigued over the Iranian situation. I think that most of us thought we'll go in, do whatever it is that we're attempting to do, whether you believe it's nuclear containment or if it's about oil. But we figured, a week or two maybe. It's been 6 months. And there's no progress that's been made based on what's been shared with the world, not just in the US, but with the world. And now it seems like we're fighting to get something that we already had, lower oil prices by opening the Strait of Hormuz. But I am not a political scholar, not even close, but people are getting more and more nervous. Having said that, I'm going to contradict myself on the fear greed index. Shockingly to me, I thought we would be in neutral today. Had a lower market last week, right? Oil's still choking everybody. We came in modestly in the greed category. I would be neutral or high fear, right? Meaning the high end of fear, closest to neutral. That's where I would have guessed. When I saw this, came as a bit of a surprise. Well, here's another reason for concern. There's been a shift in the outlook for interest rates. So last week, I think there's like a 70% probability there'd be no rate cut in September. Well, now there's a 57% probability of no rate cut in September and a 55% probability of a rate cut in October. So we weren't expecting our first rate cut as of last week to occur until December. Now we're looking at October. And we were only forecasted to have one rate hike. Now we're forecasted to have a second rate hike in June. What do we blame this on? I already told you. Higher oil. Oil is inflationary. And in the face of inflation well above 2%, the Fed's going to have to do something. That's kind of their job. I don't think they like the idea of raising interest rates. They understand the impact that has. Ironically, they're trying to control inflation because inflation hurts people at the bottom of the economic scale. But let me give you the reverse argument. When interest rates go up, right? Wealthy people, they don't have debt. Wealthy people earn interest. So it helps them. Who does it hurt? Somebody living off of a credit card, somebody in between jobs. So finding that happy medium, that balance, it's tough. Which pill do you swallow? Do you raise interest rates, presumably to lower inflation? Rich people now earn more interest. Poor people now pay more interest. Or do you drop interest rates? Inflation and the cost of things goes higher, but the people at the bottom pay less in debt service. People at the top make less in interest. That's why they've got some 400 PhDs that are part of the Fed. Last week's this is year-to-date sector performance, excuse me. The S&P year-to-date is up 11.69%. Overall, it's been a pretty damn good year. Now, that's led by energy. I throw that out because that's all due to war. So then, to me, the big winner is technology, still up 18% year to date, right? We're a little more than halfway through the year. That's fantastic. Materials is now ahead of industrials. Industrials has pulled back. Some of those stocks got a bit ahead of their skis. They're running really hot multiples. And that was all fueled by AI data center construction. So materials up 17%, almost where tech is, and industrials about 15%. Real estate 12.19%, and healthcare 12.18%. So they've beaten market averages. Everything else is below, and the only loser is utilities, interestingly. The most conservative, maybe with the exception of consumer staples, but utilities is one of the places people run when they get scared about the future. So, news of the week. Let's see what we've got coming out this week. Um, so Wednesday is going to be a very interesting day. So today, Monday, as I'm recording, maybe not the day that you're listening, nothing happening. On Tuesday, you get some new home information. Um, Consumer confidence numbers going to come out. Any of that going to move the market? No. Wednesday. So we get durable goods, which is kind of a proxy for the economy. Those are people buying refrigerators and stoves and all that good stuff. Second estimate of GDP for the quarter. Personal income, how well are workers doing? Consumer spending, their propensity to put money back into the economy. PCE, personal consumption expenditure, which is really the metrics that the Fed looks at when gauging inflation. And the real number for them is the core PCE, which is the PCE minus food and energy, which are so variable. So that's a big deal. I mean, Wednesday, there's a lot of data coming out. Turn on CNBC or Fox Business, check out what's happening. Thursday, we get weekly jobless claims, which came in lower last week than forecasted and lower than the week before, which was kind of nice. Um, I don't think anything else is going to move the needle. And then on Friday, we get University of Michigan consumer survey. So Wednesday of next week, right? Check out the data. It's going to tell you a whole lot about how the market is likely to respond. All right, let's check the charts. When in doubt, always check the charts. Let's take a look at, Moderna has pulled back a little bit at the SPX. So here is the S&P 500. So first thing I like to do, there's your yellow line. That is a 50-day moving average. So the two questions I ask, question number one, what is the yellow line doing? It is sloping up. So that is bullish, not dramatically so, slightly. And are we above or below the yellow line? We are above. So that is also bullish. But notice that gap between the pricing and the yellow line is getting narrower. We had a rounded top that is decidedly bearish. So now the real question becomes, do we hold the 50-day moving average, which is sitting at 75.46. Right now we're at 76.59. So as long as we stay above the 50-day, we're fine. So the overall trend, even though we've got a fair amount of volatility, we're still bullish. If you were to ask how bullish on a scale of 1 to 10, I'd give you about a 6. Looking at the MACD, it has just turned bearish, but by a very small margin. And the RSI is kind of rolling over, much like the market. OBV, on balance volume, if you're not familiar with this indicator, it's a running total of volume that gets added on an up day, subtracted on a down day. It's moving sideways. So it's reflecting fairly stable pricing, even though the market's down just a little bit today. The other thing I want to look at is the VIX, which is the volatility index of the S&P. Some refer to it as the fear index. As the market goes down, typically the VIX goes up. Market's down today. The VIX is up 4.16%, sitting at 1576. Anything close to 15, a fairly comfortable number, right? That's investors aren't paying for protection when we're sitting at those levels. So overall, I think investors are feeling kind of okay about things. All right. So now, in taking a cue from one of your fellow viewers, they want to know where do you go to evaluate the fundamentals of a stock? So I'm going to give you a couple of sites that you can check out. By the way, if you like the software that I'm using, it does a whole lot of fundamental analysis. I just thought of this. Um, the developer charges $39.95 a month for this. I'll give you a 30-day free trial if you're interested. Just hit me up with an email, and I'll give you a link so that you can get that free trial. But let me just show you. If I were to put in a company, here's Apple. So up here it says fundamental. And I can very quickly see this is quarter by quarter earnings. So I can look to see, what is happening with their earnings. It's a really nice visual. So that works out well. Down here shows the earnings growth rate at 13.30%. The PE is 35. Projected price 413. The stock is at 311. So according to the simulator, it still looks like a pretty good buy. Profit margin 27.62%. It's interesting. Let me just do this for fun. Everybody complains about the money that big pharma is making. You want to know what the profit margin is right now for Pfizer? It is 6.8%. That's what they make by selling drugs. Apple has a profit margin of 27.62%. How come nobody's complaining about that? That they're gouging everybody, right? People, they believe what they want to believe. And when you hear something enough times, everybody buys into it. So that's a nice feature. Also, there's a dashboard here where at a glance, you can see the PE ratio, the PEG. So the PEG is the PE ratio divided by the earnings growth rate. So that's what I focus on. Amateurs focus on PE ratios. I think they're damn near worthless. I focus on PEGs because they take into consideration the earnings growth rate, which is pretty important. This also shows what the insiders are doing right now. They are net sellers. We can see percentage of the outstanding stock that is owned by the insiders. is 0.06%. There's so much stock out there, right? In the beginning, this would have looked a lot different. Um, and let's see, number of buyers, number of sellers, how many top tens are they in for survey purposes? 8 of them. You see the fundamentals down here. So you have earnings growth rate, right? You have profitability, including return on equity, return on investment, cash flow, key ratios. So that's one way to look at the fundamentals. Another way would be, why don't we stick with Apple? Go to Yahoo Finance. So I'm going to type in the symbol and it's going to pull up. Here are your fundamentals right here. So it shows the previous close, the opening price, the bid, the ask price, the day's trading range, 52-week range, volume, the average volume. Apple trades 56 million shares a day. Market cap, this is the value of the company. So that's determined by number of shares of outstanding stock times the price per share, 4.546 trillion. The beta. So the beta is a relative number, and it's relative to the volatility of the S&P 500. So Apple's at 1.09, which means it basically moves at the same rate as the S&P. PE ratio 35.72, earnings per share trailing 12 months, that's TTM, 8.72 or $8.72 per share. Earnings date, next one is October 29th. Forward dividend and yield. So it's not much of a dividend payer. There's always been a lot of squawk about the fact that Apple has a ton of cash and they should use it for paying out dividends. They only pay 0.35%. Ex-dividend date is August the 10th, which means that who gets the dividend? Shareholders of record as of August 10th. And this is a 1-year target estimate. This one has it at 324. These estimates about where the price is going to be, it's just people's opinions. Whose do you believe? I don't believe any of them. There ain't anybody on the planet can tell me where the price of stock is going to be. Now, here's a site you may or may not be familiar with. This is Koyfin, Koyfin, Koy Financial, Koyfin. And I've got Nvidia pulled up. So this goes into some pretty heavy duty detail. Now, everything is going to be relative to other stocks in that particular sector. But if you just wanted raw numbers, let's take a look at this. So key financials, total revenues, those numbers are so insane, but you can look at what the trend has been, right? So we go from 26,914 in 2022 to 253,491. You have to multiply that by a million. Year over year growth for 2025, 114%. You see why I like Nvidia? And for so far this year, 65% growth. Is that insane? Gross profit, the gross profit went up so far this year, 71%. Are you kidding me? 71%. EBITDA, earnings before interest, taxes, etc. growing at 61%. Net income growing at 55%, diluted earnings per share, and then the PE of 39.9, trailing, looking forward about 33. Talk about market cap. Company is now worth $5.2 trillion. Um, well, that's our forecast at the end of the year. Right now, 4.7 trillion. Yeah, pocket change, right? Shows how much cash they've got, 62 billion in cash. You talk about fat cash. That's it. Total debt, 11 billion. Why would they carry debt? Because they can borrow money at a lower rate of interest and reemploy it at a higher rate. It's called arbitrage. Enterprise value estimated 4.7 trillion. So this gives you, I think, a really nice picture of the fundamentals on a company. You really couldn't want for more than that. So, if we wanted to go to Apple, well, let's do Micron, since I own that stock. Let's look at highlights. That's what I had up before. So Micron year-over-year growth anticipated by the end of this year, 166%. Profit margin, 72%. And we're complaining about pharma we're complaining about pharma at 6%. Get a clue, people. And you know what? I could probably do without Micron technology. I'm not so sure I could do without pharmaceutical companies. They're easy to complain about till you need them. Earnings growing 75%, net income 55%. I mean, this is a must-own stock as far as I'm concerned, without giving you any investment advice. Now, it's an expensive stock, $914 a share. And I'd also buy in a pullback because Nvidia does have pullbacks. But so between that software that I use and these two external sites, Yahoo Finance, Koyfin, I think you're in pretty good shape. Fantastic. Thank you for hanging with me once again. I always really enjoy doing these. I really enjoy the prep work that goes into it. So again, my email, steve.sitkowski@gmail.com. So if you got a topic you'd like me to cover, you have a question you'd like me to address, there's going to come a day when this whole thing is going to be nothing but me talking to people that have sent in requests. I'll look forward to that day. All right. Have a fantastic week. I will see you same time next week. Until then, be safe, be blessed. Bye.